So in this video, I want to take a closer look at the most recent correction and try my best to put it into perspective. So we all know that the beginning of 2022, basically on the dot, the stock market across the board began to tank. And we can point to two major causes behind this. One is inflation. I would say this is the biggest deal right now, economically speaking. And the second is all of the uncertainty overseas with Russia and Ukraine. Those two things largely explain all of this volatility. In fact, right here is when the Ukrainian war started. And just recently, the Fed finally officially raised interest rates, and all of this prior volatility was the anxiety around that. And then, of course, once it actually happened and it wasn't as bad as we all thought, it bounced a little bit. But I do want to zoom out a little bit and say that this decline of 15-ish% really isn't uncommon. Yes, the circumstance is unique, history is always changing, but the reaction is pretty typical. On average, the S&P 500 has experienced a correction once every 2 years, which is roughly 10%, a bear market once every 7 years, around 20%, and a crash once every 12 years. And if we come back to this chart here, we can see it's been about 2 years since we had anything but positive price action. And if you want to look at the NASDAQ, the numbers are actually a little bit worse. So here a correction happens every 2 years, a bear market every 4 years, and a crash every 7 years. But getting back to the current situation, it does look like the worst of this correction is now behind us, and we seem to be recovering. And a couple of data points we can look at to try and confirm this are things like the VIX, which is a measure of fear and volatility in the market, and recently it's been taking a nosedive off of its peak. We can also take a look at some of the more volatile assets that really took a beating, like the ARK Innovation Fund. The main factor causing this huge correction was the rise in interest rates. But now since it happened, over the past 5 days, this has rebounded almost 20%. And for comparison, in the same time, the market is up about 6%. So based off of all that, this looks like a pretty typical correction, and the worst might be behind us. But that, of course, is until you look at this chart right here. And this is known as the mean reversion, and it's very simple and pretty beautiful in its own right. And essentially what it says is that day to day, the movements of the stock market can be very chaotic and unpredictable. But long term, stock market returns tend to adhere to a somewhat predictable upwards trend. And that trend line is what we refer to as the mean reversion, and it represents the average stock market return of 10% per year. We can see there's some periods where we underperform that, and others where we overshoot it quite significantly. But ultimately, we revert back to the mean. And unfortunately, even after this most recent correction, we can see just how overvalued we still remain. In fact, right here is a different view to show the same thing. So this 0% is the average, and we can take a couple things away from this graph. So back in the 70s and 80s, when there was a gas shortage and interest rates were in the double digits, the growth was below average. We can see the rise and fall of the dot-com bubble right here, as well as the bottom of the '08 recession. But of course, the bad news for all of us current day investors is that this 15% correction we have is still nowhere near enough to get back down to the average. And that's why the market is still viewed as being overvalued. Now, I'll leave this article linked down below if you guys want to read the whole thing, but I do want to quickly echo a concern that they voice. And that's that all because we're above the mean doesn't mean that we can't stay here for potentially decades at a time. So this tool by no means predicts a crash in the coming weeks or anything like that. It simply puts the current market in perspective long term and in comparison to the average. Hopefully this chart gave you some perspective on the current situation we find ourselves in. And if you want my opinion on the short-term outlook of the stock market, I think it's going to be pretty flat over the next year with a lot of volatility. In fact, a couple months ago, I made this video on my warning to index investors, and this was before the most recent crash, and you can see my rough S&P 500 prediction over the next year. And I gotta say, I stand by that. So if that is indeed the case over the next year, not too much capital appreciation and a high level of volatility, how do we invest? Well, if you do some Googling, you're going to find articles like this that give you some advice on how to invest during bear markets. The first one is just dollar cost averaging, and I have to say this is definitely the go-to method. Nobody knows what's going to happen, so you might as well average in over long periods of time. But then right here at number 2, they say income investing, and that's what this channel is all about. And one ETF has been holding up extremely well in this environment is actually XYLD. This, of course, is very similar to its sibling ETF, QYLD, which is a lot more popular, but one of the major criticisms with these ETFs is how they perform during a down market. Now, if you follow the channel, you should know exactly how this ETF should perform, at least theoretically, in different market conditions. But at least now we have actual real-life data to back all this up, And the results are pretty telling. Not only has XYLD held on to its value better than the S&P 500, but during this volatility, the monthly dividend yield is at an all-time high. So you can see how an investment like this, or just general income investing, is a great hedge or opportunity during a volatile market like this. But putting income investing aside, there's another great strategy I want to shed light on for this potentially rocky market over the next 1 year. And that's to simply keep an eye on the VIX and invest when it spikes. In fact, if you invest in the stock market every time the VIX spikes above 30, 35 points, you could easily outperform the market. But don't just take my word for it, there's actually research on this topic. I'll leave this whole article linked down below if you guys want to read it, and by the way, I highly recommend it. But it says right here, our research indicated that the optimal returns, historically speaking at least, were achieved when the VIX moved above 33. So to me, if the market is going to be flat and volatile over the next year, look at the VIX and wait for spikes in it to potentially average in to high quality companies that you want to buy. Due to the inverse relationship between this and the S&P 500, it can be a great indicator to identify discounts in the market. So there you have it, guys. We're going through one of the first corrections we had in quite some time. But if you look at the most recent price history over the past couple of days, it looks like we're coming out of this correction, and that might very well be true. But if we zoom out a little bit and try to gain some perspective, the stock market as a whole still is quite overvalued. Now again, this doesn't predict a market crash coming in the next couple of weeks or anything like that. It's just something to keep in mind. If you guys are still watching and enjoyed, I appreciate a like on the video. Go ahead and subscribe if you really enjoyed, and I'll see you guys in the next one.